And let me share my screen as well. Okay, I'm assuming everyone is able to see the screen. Okay, good. So yes, as per the first day revision timetable, we are going to start with the 3 topics, and these are the most important topics for our from the exam perspective. Many people has given the feedback that there were some questions from the gift tax, estate tax, and the final descendant tax return. Okay, so before I quickly start with the revision session, I'll give you just 3 small ground rules, just because we are recording it for other students also. So this is just a quick recap. Okay. Okay, wait. Yeah. So just a quick recap. I'm not going to explain each topic in detail. So those who were from the regular batch, they will understand the difference. It's not a detailed version. It's totally from our summary book. If you have summary book, that's good. If you don't have summary book, you can connect with our admin team to get it. Even if you don't have summary book and you're just revising it, just attend the class with a very attentive mind. It will be very easy to understand. Okay, and we are going to do all the topics. It's not like just important topic or few topics. Each and every topics of part 1, part 2, we are going to revise. Second thing is, I would request, like, I have not restricted anyone to mute unmute, but I would request to just keep yourself on mute until and unless the recording has been paused or stopped, because this is, again, I'm repeating, it's going to be uploaded on YouTube for other students. Last is doubts and questions. If you have, yes, you can post it on the chat box, our Zoom chat box. And even if after class, if you have any doubt, you can just accumulate it, or make a list of it. On last day, we will have a doubt solving session for everyone. That is for everyone. Those, I can understand if you guys have exams in August or at the end of August. If you have any doubts which are still not clarified, you can ask on the last day. Okay, so I hope just this 3 small rules I have, that's it, nothing else. And let's start with our day 1. So today we are going to understand about the gift tax, estate tax, and the descendant final return. So before moving to the 3 topics, I'll give you just a small overview. What exactly is the estate and gift tax and trust return? Trust return mainly will come in the part 2, but there's a linkage between estate, trust, and the descendant final return. Okay, so let's take an example, Mr. X. Okay, wait. Yep. Let's take an example. There is a Mr. X who died on 30th June 2024. For your exams, it's not 2025 tax law. For your exams who are going to appear till Feb 26, your tax law will be 2024. So even if you search something on Google, make sure to put the last line as whatever is the limit for 2024 tax law, not 25 tax law. Okay. So for example, let's say Mr. X died on June 30th, 2024. So first year, the year in which he died, the filing requirement will come in the month of April. Okay, April 2025. So his final return will be filed as of the normal due date. Our normal due date is 15th April for the individual taxpayers. So we need to file his final tax return. Like this person died, so whatever income he might have earned from 1st January till the date of death, we need to report it to the IRS. We need to pay the tax. So Mr. X is not alive. Who are going to report it? Their descendant. Whoever are their beneficiaries, representatives, they are going to file. Let's say Mrs. X, okay, the spouse of X. That person will need to report the income to IRS till the actual deadline, that is 15th April. Okay. Now what happens? This Mr. X is, let's say, a businessman. This person is having few rental properties. So it doesn't mean that the person died means his business has been stopped, his rental income has been stopped. He still might be earning some income. Okay. So what will happen after 30th June? Okay, whatever income is being generated will get reported in his estate return. Okay. Just a minute, there's a notification. Okay, got it. So whatever income is being generated, even in the absence of Mr. X, will be reported on estate return and later on in the trust return. Okay. But understand the deadlines in the estate tax return, in the descendant final return. You need to remember the deadlines. You need to remember the limits. Okay. So Mr. X died on 30th June. From this date, within next 9 months, whoever is the representative, whoever is been assigned to take care of the estate, need to file the estate tax return. Okay, I'm just going a little bit slow on this topic. If you understand this diagram, it will be very easy to remember the topics. Okay, from the date of death, you need to file a estate tax return within 9 months. Now, what needs to be reported on that estate tax return? What will be considered in the income? What deductions are allowed? That we will understand in the topic. Okay, just a summary, quick revision it is, but you will be confident enough before going to exam if you just look at this diagram. Okay, now on 15th April 2025, the person needs to file the final return. Their beneficiary will file. Obviously Mr. X is not going to come and file the final return. So within 9 months, whatever income has been generated will get reported on estate. Plus, this is called as a one-time transfer of the assets. So on 30th June, let's say Mr. X is owning a lot of property. Mr. X is, having his own business. So every asset will get transferred to an estate. And then from this estate, it gets allocated to the beneficiaries. Okay, so those people, those were mentioned in his will, Mr. X will. Let's say the Mr. X is going to have 3 sons, Mr. A, B, and C. They will receive the certain percentage of the estate. But it never happened that within 9 months your whole estate is going to be distributed. It will take a little bit longer time. So what will happen, as soon as this is a one time return, once you have to file the estate tax return, that's done. After that, still the estate has not been distributed, still you are generating revenue, right? Still the rental income has been generated, business income is generated. So what will happen, on those incomes, still you have to report it to IRS in the form of trust tax return. Okay, so are you guys clear with the difference between estate and trust tax return? Again, I'm mentioning, if you have any questions, anything, you can put it in the chat box, any confusion. Okay, meanwhile, this, I hope this 3 differentiation has been clear. The date of death, you need to check which tax year it is going on. It's going on 2024. What is the due date to file 2024 tax returns? It will be 15th April 2025. So this kind of, I'm just repeating it again, this kind of questions will be asked in the exam questions. Okay, so they'll give you a case scenario and then you have to understand, you have to answer it. Okay, so the date on which Mr. X died, you have to check the tax year. This tax year's return will be filed on 15th April 2025. Okay, now from the date of death, within next 9 months, the beneficiary, the representative of the estate, need to file the estate tax return. We will understand this in the next in the topic when we actually do it. And then whatever are the beneficiaries of the estate, once the asset get distributed, they will receive a K1 from the estate, which is not a part of the part 1. So no need to understand that. But yes, so they will receive the K1 in which, whatever percentage, let's say all 3 are going to receive 33% of the estate. So they need to report it in their return separately. Okay, that's a different part of story. After you file your estate return, still your estate is in existence, still you have a rental income, still you are going to have a business income. Every income needs to be reported in the trust tax return, which is 1041. Okay. Gitesh, no, it's not 6 month, it's 9 month only. We'll see that. I think you are getting confused with some different topic. So let's move one by one with the estate and tax return, estate and your final descendant return. Okay. So before moving to this detailed topic, there is one small topic, that is a gift tax return. Okay. So gift tax return is something which, let's say I'm going to gift some cash amount or some property or any tangible property or anything to any person. It can be my relative, non-relative, friend, or anyone. Okay. The person who is going to gift it will be liable to pay the taxes, gift tax, and they have to file the form 709. Yes, remember the form numbers in these three topics. Remember the form numbers, remember the limits, remember the criterias. These three things are important in all these three topics. Okay. So let's say if I am gifting a property, and let's say for a very small, for a very lesser amount than FMV. Let's say Mr. A is gifting a property to Mr. B. The fair market value of that property is 10,000, but because Mr. A is one of the relative of Mr. B or a known person, Mr. B is just paying $2,000. That's it. So what about the actual fair market value? The fair market value of the property is 10,000, but Mr. A is selling it at a very less cost. This is considered as a deemed gift, and Mr. A will have to consider it in the gift tax limitation, because everyone will not be paying a gift tax. There is a limit. Okay, so what's the limit for the gift tax? Any gift up to 18,000 per year per taxpayer. It is, just remember, it's per taxpayer. So in exam question, what they'll give you, they'll give you a list of gifts. Let's say Mr. A is giving a gift to Mr. B, to Mr. C, Mr. D. They'll give you a list of gifts. Okay. And you have to figure out how much total reportable gift tax amount should Mr. A report on the form 709. Okay, that's a gift tax return. So there you have to remember, it's 18,000 per year per taxpayer, not total 18,000, it's per taxpayer. Okay, now there are some exceptions. Okay, so there are some exceptions over here. If you're paying for someone's medical expense, if you're paying for someone's tuition fees, those are not considered under any limit. Means these are totally exempt from the gift tax. No need to pay any gift tax on those amount. Same way, if there is a gift in like in a marriage, like spouse one is paying some gift, sorry, giving some gift to spouse two. Let's say a diamond ring has been gifted from spouse one to spouse two. So that's not considered as a gift, whatever is the value, whatever is the fair market value. Okay, so it will be not taxable under gift tax. No need to report it as well. Gift to a political organization is not considered as a gift, it's a donation, and also it's not considered as a deductible, right? Charities, if you're going to give a charities, it's not a gift, it will be considered as a charitable contribution on your schedule A. Okay, so just remember this criterias. Any gift of future interest is not a gift currently. We will understand this in the next line. Gift of future interest, next page there is a topic on that. Okay, so this is about the limits, 18,000, which you have to remember, and what are not considered as a gift, you have to remember. If you're gifting, if you're just paying for medical expense, if you're paying for any education expenses, those are not considered as a gift. No limit. Let's say $100,000 or $200,000 if you're paying, there's no limit for paying a medical expense for someone else. It's not reported on gift tax return, but yes, you can take it on the schedule A as a medical expense if you fulfill the criterias that we will learn in schedule A topic. Okay, next is, yes, this is important. Always there will be straight one line question like, what's the lifetime exclusion limit for gift tax? Okay, so what exactly is this? Let's say I am going to gift in year one, sorry, Mr. X, let's take that Mr. X who died. So in year one, that Mr. X gifted someone some cash amount of 18,000. Since this 18,000 is within the limit, it's non-taxable. Same way in year 2, he again gifted someone 18,000. Every year this limit changed, but let's take an example. In year 3, this person died. Okay, now please focus on this, because in exam they will merge two topics. They'll merge the final descendant topic and the gift tax topic. This lifetime exclusion credit is very important to remember how it applies. Okay, so let's say the person died. Now, when his all asset is going to be transferred in the estate, let's say he is right now having the asset of $1 million. Okay, when it get transferred to the estate, you have to pay a one time estate tax, because when you're going to file an estate tax return, you have to pay the estate tax. Okay, and believe me, like, it will be a huge amount, because let's say the person is having a lot of properties. They will not consider the cost. All the properties will get transferred to estate at FMV. Got it? So now, one exemption IRS has given is, from whatever estate income you have, you can reduce the lifetime exclusion amount, not the whole amount. Okay, it's just like your bank balance. Let's say right now you have a bank balance of 13.6 million. Okay, but in year 1 you utilize the exemption of 18,000. Year 2 you again utilize the exemption of 18,000. So whatever is remaining amount from your lifetime exclusion, this will get reduced from your estate tax return when you actually file your estate taxes. Okay, so just understand, just remember, like, this is like, it's a kind of your balance. Whenever you take a gift tax exemption, $18,000 exemption per person, if you're taking, let's say you have gifted the amount to 3 people, so into 3 times you have to, this balance will get reduced. Whatever is the remaining balance will get applied when you are going to pay your estate tax. Okay, so that's the whole concept. It's easy to remember. Just remember the examples. Now,
I have one question. Sorry to interrupt.
Viva, just wait. I gave instruction just before the class. Don't unmute, because this is our revision lectures, just like the way I used to do since last 2 years. It's going to be uploaded on YouTube. Put all your questions on the chat box. Okay. Sorry about that. I mentioned it early as soon as I started the class. Just put all your queries in the chat box. Okay. So yes. So this amount will keep reducing as and when you are taking the gift tax exemption. Okay, got it, guys? Now, one more good benefit is, ideally in US, like 80% of people never pay estate or gift taxes. This is the reason, and this is the reason because why they do not pay. So let's say, even after reducing 18,000, let's say I gifted someone $50,000. Out of that, I straight away got an exemption of 18,000. So whatever is remaining, like for 32,000, okay, this $32,000 into whatever is the gift tax rate. The gift tax rate is 18 to 40%. So it will be a slab rate. Whatever is your gift tax amount up to 10,000, it is 18%, and 10 to 20, 20 to 40, like it's a gap of $20,000. And maximum, let's say I'm on the maximum slab rate, let's say 40% I'm going to pay a um gift tax liability. My gift tax liability is maximum like 40%. Whatever is the amount, because it is falling within this huge amount, I don't have to pay any gift tax liability. Okay, got it? Like, it's just like a filter. First filter is like, you need to check how much gift you are going to give. If it is within 18,000, forget it, just reduce your lifetime exclusion balance, that's it. If it is more than 18,000, just check how much tax you are going to pay. If this tax liability is within your gift tax liability exclusion amount, no need to pay any tax. If it is more than this, then yes, whatever is going in excess, you have to pay the tax. Okay. So deducted from, yes, it's the annual exclusion. So this is how like people get confused. It's the annual exclusion. The lifetime exclusion is your balance. Lifetime, you can exclude total 13.6 million. So let's say in year 1 you excluded 18,000, year 2 you excluded 18,000. So total how much extra you can exclude? Already you took a benefit of exclusion of 18,000 in 2 years, so reduce this limit. Okay, I hope Viva it's clear. It's this is just read the language. It's a lifetime exclusion. During the lifetime, whatever gift you're going to give, whatever your property is going to transfer in estate, you can totally exclude during your whole life $13.6 million. Okay, so it's up to you. Let's say first year you're going to take 18,000 as an exclusion. Second year you're taking only 10,000 exclusion, so you have to reduce only that much amount from this balance. Okay, Gitesh, don't ask questions on the book. It's all updated here. If your book is not updated, just talk to me later on. Okay, don't talk in the middle of the class regarding the book updation and all, right? And second thing, I'll just explain it at the end of the session, because we have came to know that people are just, I don't know who is doing that. They have scanned my whole book and they're selling it on the Telegram. Trust me, guys, it's I don't care whether you're doing this or not. It's not going to benefit anyone if you're doing it like that. But yes, let's continue. Yes. So this, I hope this much is clear. This much is clear. If you are a married person, right, now you will have a question. Like in our whole part one, we used to double the limits if the person is filing as a married, filing joint return. But this 36,000 limit is a little bit different, because you don't have to double the limit. Okay, Abhishek, as I mentioned, like it's a very quick recap. Whatever questions you have, just you can note it down. If you're not able to understand anything, note it down. If it would have been regular class, this would have been much detail. It's just a recap, revision. Those who have already done this topic, they are able to understand. Those are doing it for the first time, they might have n number of doubts. Okay, so sorry about that. I'm not going to repeat again and again any topics, because it's 40 hours session. I'm going to complete it in 7 hours, so I hope you understand. Okay, so let's say two people are going to give a gift. Let's say Mr. X and Mrs. X, they are going to gift to someone, their relative, their close relative. Mr. X is gifting just $10,000. Mrs. X is going to give $20,000. So can I say this is exceeding $18,000, right? She need to file a gift tax return. She need to pay a gift tax on extra 2,000. But what these people can do, it's not an automatic clubbing, because in other topics you might have seen, if you're filing a married, filing jointly, automatic your standard deduction will get increased. It will not get automatically clubbed because of lifetime exclusion. This lifetime exclusion is a kind of a bank balance, a kind of a balance for individual person. If they are going to club this, okay, so then the 2,000 will get applied against Mr. X amount. So they have to mutually decide, mutually agree whether they are taking 36,000 as a exclusion amount or not. Okay, it's not by default. Got it, guys? I hope you understand. And this 36,000 limit is nothing but like 18,000 into 2. Both people can club their limits. But yes, please remember, both need to file a separate gift tax return. They cannot file a gift tax return as a joint return. It's always a separate return. It can never be filed as a jointly filed return. Okay, guys? Okay. Next one is now how you're going to take the exemption and deduction. Exemption means it's totally exempt. As I mentioned earlier, if you're going to pay for medical, if you're going to pay for someone's education, if you're going to do a political contribution, it's totally exempt. Even you don't have to reduce your lifetime exclusion limit. No 18,000 limit will get applied. Okay, and you don't have to file gift tax return just because of this 3. But let's say along with this 3 you have some other gift which needs to be reported. When it needs to be reported? When your gift amount is over and above $18,000, then you have to report it on the gift tax return. Okay, so that's one thing. Now let's say if it's a it's the transfer between spouse, one spouse and the another spouse. Okay, within the marriage they are transferring some property, some valuable assets or anything, that's totally exempt. But in case of a non-US citizen, it is exempt only up to 175. Over and above, it is taxable. No need to remember, it's not that important. But in case if the question comes where one spouse is a resident, other is a non-citizen, non-resident, then you have to remember within this two spouse, whatever transfer they are making, it's not considered for gift tax unless the amount is within 175,000. Over and above that, it will be considered under gift tax topic. And yes, you have to file the gift tax return. Okay, charitable contribution, I already mentioned, it's not considered as a gift. It's a Schedule A itemized deduction. There we will see a different criterias over there for Schedule A deduction. So no need to report it if there are no other reportable gifts. But if there are, then report other gifts. For example, you have done just a charitable contribution during the whole year, you don't have to file a gift tax, right? You will straight away show it on Schedule A. But along with charitable, let's say you have gifted a property to your loved ones, and the fair market value, always take a fair market value in case of a gifting of a property. If it is more than 18,000, yes, you have to report this. Plus, you have to just mention it. You are not going to pay any tax on your charitable contribution. Just report it. Charitable gifts plus whatever other gifts you have given. And on charity, you are going to take a deduction on 1040 return. Okay, got it, guys? I hope you guys are remembering the topics. Yes. So who is responsible for gift tax? Donee or donor? Whoever is donating it, donor is going to responsible for gift tax. Whoever is receiving, they are not going to care about filing the gift tax return. So Mr. A is going to donate, so the donor is going to file the gift tax return. Okay, so that's fine. Next is deductible gifts made to the charities. Whatever charitable organization is there to whom you're going to make a charity, and that will be deductible on Schedule A. This includes taxpayer entire interest in the property. So this thing again will cover in Schedule A in non-cash gift. Okay, so let's say you are just donating a whole property, you are donating it to a church, and church can utilize the whole property for their own benefit. Okay, taxpayers entire interest in property is been donated to the church. Yes, that is deductible as per the rules given in Schedule A topic. Okay, we'll do that later on in deduction topic. Qualified conservation contribution, perpetual restriction on use of real property, means on real property, real estate property, whatever whatever rights you're giving it to someone else, you're not selling, you're not straight away transferring the name of property in someone else's name as a donation, but you are still the owner, but the rights to use the property has been transferred to someone else as a donation. So those things are also considered under non-cash donation. It is allowed as a deduction. Okay, so yes. Okay, so let's take an example. I think someone has asked in the chat box regarding the 18,000 donation. 18,000 is per person per taxpayer. So let's say you have received donation 18,000. The thing is, the recipient doesn't have to care about it. Whoever is paying will be responsible. So Mr. A is paying 18,000. Again, Mr. A is paying 18,000 to 4 individual. Let's take that example. Okay, to Mr. X, Y, Z, and C. Okay, to this people, Mr. A has donated this amount. Everything is exempt, non-taxable. Okay, why? The rule is 18,000 per person per year per taxpayer. Okay, but the only thing you should remember carefully is this should be reduced from the lifetime exclusion. So when Mr. A dies, we need to check what's his actual balance remaining after taking all these exclusions. Okay, clear? Now, the person who is going to receive it doesn't have to care. Okay, 72,000 is considered as a gift. That's fine. You don't have to pay any gift tax. You don't have to mention it anywhere. Okay, because the person is going to file it, they need to mention the receiver's details and everything. So it's already been reported to IRS. Okay. Now, this is important, not much from the exam perspective, but from the practical perspective, yes, gift of future interest. So mainly when the parents are going to pay for their child's education expense, they will think well in advance, right? So instead of paying every year, what they do, they will deposit a whole amount into a qualified tuition program. Okay, so qualified tuition program, whoever is the donor, let's say parents are donating for their child's education. Okay, so whoever is the donor, they can front load the qualified tuition program. That's a kind of an account which will be later utilized by the child for their education expense, qualified education expense. When we'll do the credits chapter, there you will understand the criteria for how the qualified tuition program, the expenses will be utilized, which will be qualified expense, which will be non-qualified and all. Okay, so with 5 years, they will front load this thing for next 5 years. So next 5 years are secure for the child's education. So the thing is, maximum how much they can front load to save themselves from the gift tax. Okay, now you will have a question like, anyways, if you are paying for anyone's education expense, that should be non-tax, that should not be considered in the gift tax topic, right? So your thinking is correct. The only thing is, Mr. X, when he's going to deposit the money in the QTP, it doesn't qualify for that exclusion, because the rule is Mr. X should pay directly to education institution for education expenses. Then only it's considered as a not a gift. It's not considering the definition of the gift tax topic. Okay, but here the thing is, you are not donating, not paying it to the institution, you're paying it in a program, in a qualified tuition program. Who knows that within this next 5 years the child is going to use it for qualified purpose or non-qualified purpose, right? So for now, the year of contribution, it will be considered as a gift. And yes, 18,000 into 5, if you have donated this 90,000, even if you have donated 100,000, maximum 90,000 will be excluded. The extra 10,000 which you have donated will be considered under the gift tax topic. Okay, and as a gift to your child. Got it, guys? Now it's up to you. Let's say if you can just donate up to 90,000 in the qualified tuition program, over and above that, straight away pay to the education institution. That will just save yourself from the paying the tax on this extra 10,000. Okay, got it, guys? So again, I'm repeating, any questions, anything which comes in your mind, put it in the chat box. I can take care of those queries, questions right now. Okay. Generation skipping tax is very simple. Let's say your great grandfather is going to pay you something and he has skipped 2 generations, right? Let's say great grandfather, then there is a grandfather, then there is a father, and there is a son. So he is straight away gifting something to son. He has skipped 2 generations. That's we called as a generation skipping tax. Okay, so this person needs to pay a generation skipping tax, and yes, he has to report it on the gift tax return as a GST. Like it's not the normal GST, it's just like generation skipping tax. If the donor has skipped 2 or more generation below the donor, so this is the donor, he has skipped grandfather and father, he's straight away gifting some property to his son, okay, the grandson. So recipient is not related to the donor. this is some family example I have given, but let's say the recipient is not related to the donor, means non-relative. It should not be a family member, someone else who is gifting to, let's say Mr. X is gifting some property to Mr. Y, and they are 37.5 year younger than the giver. So just remember, like, the difference between the age of these two people are more than 37.5 years, then the generation skipping tax will apply. And it should not be, because this will be considered as an inheritance. Okay, and inheritance will never be considered in the taxability of the gift tax return. But just to give you an example, I have explained this. Just remember the difference between the donor and the donor's age. If it's more than 37.5, then yes, generation skipping tax will apply. Again, even if, let's say, they have gifted something which is around $100,000, right? So this $100,000 is way more than $18,000, and yes, you are going to pay generation skipping tax on this. And whatever you're going to exclude, again your balance will get reduced. Just remember, lifetime exclusion limit, this 13.61 million dollars limit will apply to three things. Okay, gift tax, estate tax, and your generation skipping tax, if you are going to not pay any taxes then. Okay, got it? So any exemption, just remember, if you're gifting something, any exemption which you have taken will ultimately reduce your lifetime exclusion balance. This balance will be fully used when you file a final estate tax return for that person. When the person dies, we have to check whatever is a lifetime exclusion limit, that fully will be utilized in estate tax return. Okay, those who have joined late, just watch first few minutes. I have given a small understanding of the difference between these three returns to make it clear. Okay, next is regarding the due dates. It's our normal deadline, that's the 15th April. Maximum tax rate is 40% and minimum is 18%. It's like a slab rate. So 0 to 10,000 you have to pay 18%, then 10 to 20. So the gap of $20,000, it will increase by a certain percentage, and maximum it will be 40%. No need to remember the percentage, no need to remember the slab. They are never going to ask you the tax calculation. Okay, it's always done by the software. But just remember the criteria, exclusion limits, and the form numbers. The gift tax topic is all about this things which we have done till now. Okay, so if you're going to, when you're going to file your gift tax return, always there is a confusion between gift tax and estate tax form number. So please remember, if you have given any gift and if it's more than 18,000, always you have to file a gift tax return. Okay, second is, important point is, if both the taxpayer and the spouse are going to split the gift. I gave you one example, right? 10,000 and 20,000 example. Mr. A was going to gift only $10,000. The spouse is gifting 20,000. So what spouse will say? Let's merge our gift. Let's split the gift. Let's consider it as a 30,000. That means it's within the limit of 36. No need to file the gift tax return. Okay, both need to file a separate return in that case. It doesn't mean no need to file a gift tax. It means it's non-taxable, but yes, you have to report it to IRS that for this one of the year, these people are merging their limit, and it's going to get reduced from their lifetime exclusion limit. Okay, uh, okay. I'll come back to one of the question later on. Okay, let me continue first. So taxpayer gives the gift which contains future interest. Future interest means what? Let's say I'm going to give some fixed deposit, but the fixed deposit will be due after that person achieves the age of majority. Let's say I gifted to one of the cousin who is still minor, and he is not under any position to receive, to sign, or he is not having any legal position. As soon as he reaches the age of 18, after that he will receive the gift. So it's I'm giving a gift today, but it will benefit him in future. It's a future interest gift. Still, it's considered as a gift. It's non-taxable, right? Right now, it's non-taxable, but still, I have to report it on the gift tax return. Okay, I'll come back to this point. It's there somewhere above. So, taxpayer gave his spouse an interest in property that some future event will end. So, let's say a limited gift. Let's say you have given some gift for 3 years or 4 years. 4 years, the spouse can, have the rights on that property, or uh, in some future date it can be revoked or it can be cancelled. Okay, still you have to file. So this is related to when you are going to file a gift tax return. Okay, the limit you should remember: 18,000 lifetime exclusion limit, $13.61 million. And the tax liability calculation we'll do in the estate tax topic. There's a small calculation over here. Okay, so we'll understand how the tax liability limit will be excluded, $5.3 million, which we have seen. Okay, so any questions from the gift tax topic, just post it. There's one question, I'll quickly take that for solving it. Do you still file and report if I receive up to 18,000? If not, how do you calculate lifetime exclusion? So let's say I'm going to pay 18,000. I'm going to pay $20,000 to someone in cash. Okay. So can I say it's over and above 18,000? But I can take an exemption of 18. So whatever is over and above 18, that 2,000, I'm going to pay a gift tax. I have taken an exclusion of 18,000 already. Okay, so I have to file anyways to pay this gift tax. I have to I have to file the gift tax, and I am going to consider this 18,000 as an exclusion from lifetime exclusion. Now, your question is, let's say I've just gifted to one person whose the gift amount is 18,000. I'm not going to file a gift tax return. I'm not going to mention anywhere to the IRS. Okay, how will my lifetime exclusion limit get reduced? How the IRS will know you are going to reduce it? Even if you even whenever preparer is going to prepare the return, they have the checklist. It's all mentioned in the checklist. So even if the preparer changes, it's the new preparer's responsibility that when they are going to file the estate return. Right now it's not going to be caught anywhere. But when the person died, Mr. X is going to die, and let's say every year he has just paid $10,000 every year, constant 10,000, 20,000, like $30,000 he's paying, and taking the exclusion of $18,000. Okay, or he's paying within the limit without even filing the gift tax return. It will be the responsibility of the representative, the fiduciary, who is going to file the estate tax return. The executor needs to finalize what's the remaining balance in the lifetime exclusion account. Okay, he need to figure out. We don't have to worry about it, even if you're not going to file a return. Okay, so the executors is going to be responsible for that. Good question about that. Yeah. Next is will come when filing estate. Okay, one more question. So lifetime exclusion will come when filing estate tax return. No. Lifetime exclusion applies to all three returns. Gift tax, yeah, the utilization of the balance. I'm just using the word balance. It's a kind of your lifetime balance. Whatever is remaining balance will be utilized when you are finally filing your estate tax return. Okay, so utilization will come in estate tax return. The reduction will be going on every year. Whatever gift you're going to pay, whatever exemption you take, that exemption amount will get reduced from your lifetime exclusion. Okay, so yes, so what is estate tax? I already explained a little bit in the starting of the session. To repeat it, if the taxpayer dies, whatever is the cost of the property, land, stock, and other asset, okay, that is still standing in his name. He's still the owner. The person died, he's still the owner, right? if he has written something in his will, let's say I want to transfer, let's say Mr. X is dying, he want to transfer it to three of his grandson. So these three people will become the beneficiary of the estate. Okay, but these people are going to receive their share of estate only after filing the estate tax return. So when you file estate tax return, all your cost of property, land, stock, and any other asset will get transferred, will get converted into FMV. Whatever is the difference between the cost and FMV, let's say the cost of your estate was 100,000 when you bought the property, when you bought the land. Let's take the total cost to accumulate all this asset is 100,000. Now the fair market value of this all asset is $5 million. For example, let's take an example. Okay, the person lived for like 70 years. So this has been increased. The fair market value is now $5 million. Okay, so what is the difference between 100,000 and 5 million? Whatever is the difference, this is called as a appreciation in your assets. One time tax will be paid on this amount. Let's take a round figure to give you an example. 1 million was the cost, now the value is 5 million. So you are going to pay tax, estate tax, on $4 million. But here the story doesn't end. You still have your lifetime exclusion balance. Utilize the whole balance. Let's say still you have a balance of $9 million. You will not get any refund. Okay, so the whole $9 million can get utilized and you don't pay any estate tax at this point. Okay, got it, guys? So after paying this estate tax, whatever estate balance is there, like even after paying the estate tax, the estate is not yet been taken care, right? The executor has not yet distributed the assets. Still it is generating some revenue. So what you are going to do is you will have to file every year trust tax return 1041. Every year you need to pay the tax in the form of 1041. 1041 will also provide a K1s to all the three beneficiaries to whom still the assets are not yet distributed. Okay, so just to link these three topics all together to understand the concept of the topic. Else it's like just you're mugging up the things and limits. Got it? Now it's been transferred to the beneficiary. When it is been transferred to the beneficiary, understand this thing. What's the time limit to file? Okay, so someone said that it's mentioned as a 6 month. Let me check. I don't think so. It's like 6 months. It's always you have to file your estate tax return in 9 months from the date of death. This I'll explain what this is called as a alternate date. I'll explain what it is about. Okay, so what happens within 9 months, you have to file your estate tax. Let's take a simple example to remember it. 30th June 24 for your exam. Yes, 24, the person died. From here, just calculate the 9 month. Okay, so it will be like July, August, September, October, November, December, Jan, Feb, March. Yes, 31st March. 31st March 25. This is the date where you have to file your estate tax return. And after that, on 15th April, you will file your final return. This 1040 final return. Here you will file your 706 estate tax. Now the thing is, this estate is not having much asset or not having much things. So even before filing the tax return, the whole estate got dissolved. Like every asset was distributed to the respective beneficiaries. Okay. So when you're going to file your estate tax return, here is the rule, right? You have to mention every asset on the return at their fair market value and pay the one-time tax. Now the thing is, the FMV should be taken as of which date? Because we have already sold our asset. Sorry, not sold. We have already transferred all asset to their beneficiaries. Okay, before filing the estate tax return. So you have to take the FMV. It's at the discretion of the executor who is going to file your estate tax return, who is taking care of distribution of the assets and all. So either he can consider this FMV as on the date of death. Okay, on the date of death, we can consider the FMV on 30th June, or he can use the alternate valuation date, which is given by the IRS as 6 months from the date of death. Okay, this is for reporting the FMV. Okay, I hope someone asked previously the question, so it has been cleared now. So FMV on alternate valuation date can be reported. It is at the option of executor. But let's say before 6 months or before filing the tax return, all the assets are distributed. So you need to take the FMV as of the date of distribution to file your estate taxes. Okay, there will definitely be a question on this thing when you have to take the FMV. It will be decided by executor. Executor will always take whichever is lower to file the lower taxes, to file the lower amount of income on lower amount of value on the estate return. So FMV on the date of death, FMV on the alternate valuation date, or FMV on the date of distribution if whole, like all the assets are getting distributed earlier. Now there will be a question in your mind. Let's say not all the assets are distributed, only 5 assets are distributed. Still there are 95 assets pending to be allocated. So just for this 5 asset, you will take FMV as of date of death. But for remaining 95 asset, you can decide FMV on the date of death or FMV on alternate valuation date, whichever is lower, ideally will be taken by executor. Okay, got it, guys? Again, there's any question or anything, just put it in the chat box, right? Estate will be taken care by the executor, and still, even after filing the estate tax, even after filing the estate tax return, still your assets are generating some income. You have to continue filing your 1041 return, that is your trust tax. Okay, that will be filed by the trustee, which will be appointed. Maybe the executor can continue, or it will be the mutual discussion of the beneficiaries and they'll appoint accordingly. Alternate date is always fixed, given by the IRS 6 months from the date of death. Let's say the person died on 30th June. So plus 6 months, it will be 31st March. 31st March. Sorry, not 31st March. It will be 31st December. Okay. So it's fixed 6 months. Someone asked the question. So to answer your question, its alternate date is always 6 months from the date of death. It's the definition of it. Fiduciary. Now, fiduciary means it's like they are acting on behalf of the estate. Okay. So no. Estate tax is not, again, don't get confused. This is a gift tax. Gift tax is always filed on 15th April. Estate tax doesn't have a fixed date. It depends on the date of death. From date of death, you have to file it within 9 months. Again, don't get confused between 9 months and 6 months. 6 months is on what date you have to take the FMV while filing your estate tax return. So don't get confused between these 2 dates. Okay, 6 months, 9 months. 6 months is just for the valuation purpose. 9 months is the deadline till what you can file your estate tax return. Okay. Fiduciary is someone who is like kind of a taking care of your property on behalf of the beneficiaries, because beneficiaries might be working somewhere might be living in some different states. They are not going to take care, they are not going to leave their active work and going to take care of the properties and all. So fiduciary is a kind of a person who has been appointed, who is going to hold the property or asset for on behalf of beneficiaries, and whatever is the income generated before passing the property to the beneficiary, it will be reported either in the estate tax if it has been generated within that 9 month of filing, If it is generated after filing your estate tax, it will be reported on the 1041 as a trust income. Okay, so those who are also going to appear for part 2, trust topic is mainly the topic of the part 2. In part 2 revision class, which will also happen today, we are going to have a 1041 topic. If you want, you can attend that as well. Can 1040 final return be filed before filing estate? Yes. Let's say if the deadline that we are going to come on the next page, I think. Yeah, when we'll do this final descendant return, I'll explain it. So let's say if a person dies, and if a person dies in December, okay, from this 2024, okay, from this, if you calculate 9 months, it will be September 2025. But before that, we have to file a final tax return. Okay, because the deadline for the final tax return is fixed 15th April of that year. So the person died in December. Now there will always be one confusing question in the exam. Let me draw a small timeline to explain you. In case of a death which happens between Jan 25 to April 15, okay, 2025, your exams, again I'm repeating, your exams are based on 2024 tax law. Whatever tax law applies from Jan 2024 to December 2024 will come in your exam. But the thing is, when a person dies in the middle of tax season, let's say between somewhere here in Feb 25, the person dies. So for 2024 return, the can I say the person was alive during the whole year? So you cannot file final tax return for 24. It will be your original return, original 1040 or normal 1040. But whatever has been reported between Jan till Feb, this will be considered under final tax return, and it will be filed in next year 2026 15th April, because the person died in which tax year. Again I'm repeating, you have to check which tax year the person died. Tax year is 2025, so the tax return will be filed in 15th April 26. Okay, got it guys? I hope this much is clear. There will definitely be this kind of confusing questions, so please be aware about it. Just if you're confused, draw a timeline on your rough paper and understand what will be the answer. Okay, let's take an example. Estate or a trust generated an income of 6,000, out of which 4,000 is given to beneficiary before distribution of asset. So whatever trust income is there, 6,000, let's say the trust means even after filing estate return. So you should understand the terminologies. What is estate? What is trust return? So 6,000 was generated through trust, and out of that they allocated 4,000 to beneficiary. Let's only one beneficiary is there. So they already issued a K1 to this person, as 4,000 as a distributions already has been given. Okay. Now either of them, either the trust will pay the tax on whole 4,000, or the beneficiary will pay the tax on 4,000, and the estate is liable to pay trust is liable to pay the tax on remaining 2,000. So either of them are going to pay the tax. Now just remember one thing. Let's say the trust has already paid the whole tax on 6,000. When the trust is distributing this 4,000 to the beneficiary, the beneficiary again is not liable to pay the estate tax, trust tax. Please remember, trust tax is different. Your 1040 normal income tax is different. Okay, so two different taxes you are going to, this will be considered for your total income calculation, but you don't have to pay the trust tax. Okay, I hope it's clear. This 6,000, if it is not paid by the trust fully, let's say the trust says like that I am anyways distributing 4,000 to the beneficiary, I will pay only tax on the remaining 2,000. Let him pay the tax on 4,000, whatever I have distributed. Okay, then also it will work. So either of them will pay tax on 4,000 and 2,000. Okay, will be paid by the fiduciary on on form 1041, and they have to file 1041. The deadline is the normal deadline, which we'll see in the further topic. Okay, in further pages it will come again. Got it, guys? Now, again, the value of the gift during the lifetime exclusion, this we have done in detail. $13.61 million will fully get applied when you file your estate tax return. So how it has been calculated, let's look at the quick calculation. Let's take an example, the fair market, because when you're transferring all your asset from individual ownership to an estate, it becomes a property of estate now, right? So it will be transferred at what amount? Fair market value. Okay, so whatever is the fair market value, let's say 100,000. Okay, deduction allowed means you just need to reduce the costs of FMV minus cost. Whatever extra appreciation on that property will be liable for tax. On that, you have to straight away utilize the full balance which you have in your lifetime exclusion amount. On that, you are liable to pay the estate tax. Okay, now here you don't, as I mentioned, 90% of people never pay the taxes, but yes, on this amount you will calculate what is your estate tax amount, what's the liability, apply the rate. Here is your liability. Again, if you remember in the gift tax topic, there was a liability exclusion amount. So if your gift tax liability is up to 5.3 million, you are not going to pay any estate taxes. Okay, if the liability is exceeding this amount, over and above this, you will pay the tax. Let's say it's just $1,000. Yes, you have to pay this $1,000. It's above your exclusion limit of your tax liability. Okay, yes, one thing is, let's say the liability is just $2 million, and this is also like 5.3 million. If this amount is not fully utilized, so let's say 3 million still you have, okay, it's not utilized, it get transferred, it will get clubbed to the surviving spouse estate tax liability limit. Let's say surviving spouse has never gifted anything, she still have a balance of $5.3 million in the tax liability balance. Add $3 million, so she can be saved from paying any estate tax liability up to $8.3 million. Okay, I hope that's clear. Now, if I talk about this deduction, yes, cost is one of it. What other deductions are allowed? Because we can never take funeral expenses, any debts which are owned at the time of death. Okay, these all expenses are not allowed on 1040 return. Why? Because those exclusions are allowed when you calculate your estate tax liability. Please remember that this list you should remember very well. They might give you a list, few expenses they will give you, and they'll ask you like whether it will be allowed on 1040 descendant final return or estate return. Estate return, it will be allowed if it's a funeral expense. Any debts which is owned at the time of death, means any liabilities. It's like you are just calculating the net worth of a person. All the assets, fair market value of assets minus any debt which has been owned. Because from that fair market value of assets, the liability will get settled off, right? So you have to reduce that debts. Any admin expenses which you might have incurred, the beneficiaries, the people who are going to take care of filing the taxes, they might have paid some court cost. The executor might have received some fees to work on filing the estate returns and distribute the assets. So all those fees will get reduced from your fair market value. Marital deduction, so even after the death, any property has been transferred by the deceased person to their spouse, it is considered as an exclusion. So whatever is the value of the property that passes to the surviving spouse, only if that person is a US citizen, is considered under exclusion. First, obviously, you have to add all the fair market value of all the property and then take one by one deduction for this amounts. If the person has mentioned it in the will, okay, I think it's not mentioned here, but yes, if the person has given the specific instruction in his will that out of my estate I want to donate $200,000, then that charitable deduction is allowed to be reduced from his from the fair market value under the estate tax calculation. Okay, any state taxes which you might have paid, that will also be allowed. Any losses due to casualty or theft, let's say any of the property got destroyed even before it get transferred to the beneficiary, maybe it's stolen, it's been destructed, so that losses can be reduced before calculating the estate tax liability. Okay, so this deduction list you have to remember very, very carefully, and don't get confused with the final tax return. Final tax return is just like your 1040 return. It doesn't, we will see that it doesn't have any additional things, but these expenses are only and only allowed on your estate tax calculation, not on your 1040. Okay, yeah, sorry. Next is, just like your normal return, you are allowed to take some credits. So let's say a person might have paid taxes in foreign country for death. Okay, so foreign death taxes paid, it is allowed as a deduction. Credit for federal gift tax on pre 1977 gifts, so that's a totally rarest thing you will see in any of the return. So any gift which you have given and it is pre 1977, means while you are calculating your lifetime exclusion limit, you have to check the whole life during which you have given the gifts. So before 1977, whatever gifts you have given, on that the rules were different, right? So at that time there were some credits which were eligible, so those credits will be allowed as a deduction. No need to remember, no need to mug up these things. It's just a very rarest point. Just I'm explaining since it's there in one of the topics. So taxes on the prior transfer. So earlier, if you have already transferred some property, or let's say before calculating this estate tax liability, as I mentioned before 9 months, the whole asset has been transferred, and when you're transferring it, yes, you have to pay the estate tax, and then it get transferred to the beneficiary. So prior taxes which are already paid, you don't have to take again that in calculation. Fair market value will be reported in the return, but whatever taxes you previously paid will be considered as a deduction. Okay, you're not going to pay the return twice. Real estate time scenario, which covers all these three taxes to better understand the concept. Okay, Naz, I will take that in our regular class. Okay, since this is a revision class going on, don't worry. I got your point. It will be a good example. I can take that later on. Okay, or maybe after the class I can take the same example. So let's say there's one more thing. When a person dies 10 years before the date of death or 2 years after the date of death, the person who gifted has died. Okay, there are some missing diagrams over here. Descendant received a gift from a person. Okay, from a person. Now that person who gifted also died. Descendant who received a gift is also dead now, and for this descendant we are filing the estate taxes. Okay, so this descendant will have to mention that property in his estate at a fair market value, but whatever gift tax was previously paid at the time of this person's death will get reduced right now. So again, there won't be any practical question on thing. Just understand that Mr. X gifted some property to Mr. Y. Okay, but before, like, or let's say Mr. X died and in his estate, Mr. Y was the beneficiary. Okay, so when the person died, his estate has already paid the tax on the property which is transferred to Mr. Y. Already the tax has been paid, estate tax, because Mr. X died. Now, after transferring the property, and there is a gap of 10 year or 2 year from the after the date of gift. Let's say the gift happened, and just after 2 years, Mr. Y died. Okay, so this two, it's fine, no need to remember, not that much important, just understand the diagram. So in this situation, Mr. Y is going to include this fair market value of this property in his estate, but he don't have to pay the estate tax again on that FMV because it's already been paid previously. But you need to understand the time gap is most important. It should be 10 years before the date of gift or 2 years after the date of gift. The person should have been died. Okay, then you can take this exclusion that previously the person died and they already paid a estate tax. Again, if I'm receiving it as a property, as a distribution, and now the Mr. Y is considered as a dead, you don't have to pay the estate tax twice. Okay, so again, in book, if you read the theory, you'll get it a clear picture of it. Since it's just a revision, just remember this thing. Okay, next is filing an estate tax return. It's very simple. Just fill the form 706, file it within next 9 months. If a person are not able to figure out what needs to be reported on this form, and still the executor is not able to file the form within the deadline, the estimated deadline, we can get an extension of next 6 months, the same extension limit which applies to other return. 6 month extension, you can file it. Okay, now if the estate income is more than 600, or the beneficiary is going to be a non-resident person, then after filing your estate, like after you file your estate return, you have to still continue filing your 1041 return every year, the due date of which is 15th April. Okay, and in case if you're following other fiscal years, because this is like those who are going to 1041 is a kind of a, just consider it as a kind of a business return, like when you file your partnership return, when you file an S corp C corp return. So according to that, you check what's your financial year which you're reporting, Jan to December calendar year. If you're following, then it's going to be 15th April. But if you're going to follow any other fiscal year, it is going to be 4th month from the end of the year. So whoever is the personal representative, they can request further extension of 5.5 months. So this is important point. When you are following a normal calendar year, the automatic extension is 6 months. But if you're following fiscal year other than calendar year, your automatic extension becomes only 5.5 months, not 6 months. Okay, and you have to file your taxes in 4th month from the end of year. What kind of tax I'm talking about? 1041 return. Okay, again, don't get confused, just go through the regular class which we have done, and those who have not seen the regular class for this 2-3 topic, don't worry about it. Okay, we are going to do it in detail in the new batch, so yeah, that's fine. And second thing, in exam, don't think that there will be easy questions, like they'll just ask a one line question and it will be an easy MCQ exam. They will merge 1041 return, they will merge 706, 709, all these three returns, all these three topics, not return, sorry, all these three topics will get merged in one case study. And when you look at the question, you should be aware about the difference, what exactly they are asking for. Don't just mug up the limits, don't mug up the timelines, and understand it in a diagram format so you can remember in exam. Okay, these topics are very, very important. Okay, so what the gross estate is going to include. So last 15 minutes are there. Don't worry, whatever we are going to cover, we'll try to cover. Even if we are not able to complete the final return this one topic. That's fine, we can take it in the tomorrow's class. Okay, but just understand this, gross estate is going to include, what is gross estate, guys? All your income which you need to report on your estate tax return. Okay, so what you're going to report, the value of the property which has been transferred before death, where the descendant held a retained life interest. For example, Mr. X is still the owner of the property, but the rights to use that property has been transferred to the spouse. If you remember one example, spouse is going to receive the property rights for, let's say, 4 years. After 4 years, it will get revoked. Again, Mr. X is going to control that property. Okay, in middle of this 4 years, let's say Mr. X died, still Mr. X is the owner of that property. So the value of that property transferred before death, okay, it's been transferred to spouse, but it's still retained as a life asset. Still Mr. X is the main original owner. It doesn't matter whether the ownership, whether the rights to utilize it is been transferred. Okay, so you have to include this not as an income, but it needs to be considered in the value of the estate, because in estate tax return you don't report any income, you report all your assets, then you take the deductions. Okay, whatever is the fair market value of the assets minus all your funeral related deductions, all other deductions you take care, and then you take the lifetime exclusion, whatever is the balance remaining, that much amount you exclude. On that you calculate the tax and pay the taxes if it's higher than the certain limit. Okay, got it, guys? Next is certain property which has been transferred before death, where the descendant is having revisionary interest. Again, it's going to be retained back by the owner. It will still be considered in the value of the estate. Property transfer before death, where the transfer was revocable. These three are ultimately saying the same thing. Either it's a revocable gift. Okay, I'm just comparing it with the gift topic. So if it's a revocable gift, or if it's, it's going to get transferred back to the owner, that all things will get considered in the value of the gross estate. Okay, then transfer taking effect at the death. So let's say he might have written something in the will, or some, due to some inheritance, automatically the property get transferred to his grandson. But for the purpose of estate tax filing, you have to consider it under gross estate value. You have to pay one time tax, and then you can transfer it to any beneficiary without any extra taxes to him. So one time tax needs to be paid by the executor when he files the estate tax return. Okay, next is life insurance proceeds payable to the estate, or if descendant own the policy. So as I mentioned, like I think in the class, life insurance are never taxable, but it needs to be considered while calculating the gross estate. Gross estate is the, like all your asset. What is your what's your ownership? Every asset fair market value needs to be summed up. Okay, and it should, ideally we are not paying any tax on your life insurance proceed. It's just considered in counting your gross estate value, because the beneficiary who are going to receive the life insurance proceeds, it's a non-taxable for them. On the other hand, they have to report it in the gross estate. Okay, it's not like you're going to receive $1 million or $2 million and you're not reporting anywhere. It needs to be a part of your gross estate. Okay, certain gifts made within 3 years of the date, year of death, regarding the above mentioned property, these three properties, if any gifts made within 3 years of the death, from the date of death, before the date of death, you have to back calculate 3 years. Anything which has been gifted, still you have to consider the fair market value of those property in the gross estate calculation. Okay, value of certain annuities payable to the descendants, estate or heirs, it should be a part of gross estate. One time tax should be paid, and then it can be distributed to any beneficiaries whose name has been listed. The includable portion of joint estate with the right of survivorship. Joint estate, let's say if the person who died is still a part of some other estate, okay, and in that estate he was ownership for 50%. So that 50% ownership, you need to calculate the fair market value of that 50% ownership. That needs to be a part of your gross estate. Okay. Includable portion of the tenancies by the entirety means whatever ownership rights you have in the real estate. It's not that estate, it's a property, real estate properties, that needs to be considered. Let's say you are owning 25%, 50%, take always the fair market value of your ownership for your gross estate calculation. There won't be a huge sum on this calculation, but remember each and every inclusions which are given over here. They might ask anything, like they can twist anything in this three topics. Okay. Property over which the descendant possessed a general power of appointment. Okay. The descendant is not the actual owner, but the descendant has the authority to to just lease it or construct it. General power of attorney, actually it is. So those value, the fair market value of that authority still needs to be added in the gross estate. So don't ask me how they are going to value it, how they are going to do the calculation of everything. It's totally going to depend on the valuer. The valuer is going to provide a huge report. The executor is going to merge all of these things and come up with the value of the gross estate. And then whatever calculation which we saw in our previous page, that's a part of a tax preparer. Okay. So qualified terminable interest property. Okay. Any property which is still you are the owner and you have given the rights to use that property to someone else, and it's a terminable interest property, means anytime it will get revoked, anytime you can just ask them to transfer that owner that interest in the property back to us. So it's kind of a revocable. It is also added in the gross estate of the descendant. Dower or courtesy or statutory estate of the surviving spouse. So whoever is the surviving spouse, okay, their dower or courtesy or a statutory estate, it's a kind of let's say Mr. X, give me an example. Let's give an example. Mr. X is going to have his spouse Mrs. X, and she is already a part of some other estate. Okay. Statutory estate, I'll use the word statutory, I'm not using this words. Statutory estate, the surviving spouse is a part of a statutory estate. And sometimes what happened, Mr. X and Mrs. X both were a part of a statutory estate. So even if the surviving spouse is alive, the person dies, so when you calculate his gross estate, you need to include the FMV in the gross estate of his part in the calculation. Okay. Community property, we all know, like when the person gets married, anything which they start owning from the date of marriage till the date of divorce or date of death, all property will be considered as jointly owned by the taxpayer and spouse. So community property oh my god, yes, community property to the extent of descendants' interest as defined by applicable law, because the community property rule is different in every state wise, it gets changed. Okay. So if the state law applies the community property rule, then yes, you have to consider that 50% the value of whatever property you have owned during the whole life. Let's say spouse might have purchased the asset, but since it is going to apply the community property rule, whatever is the total property's value, 50% of the fair market value you have to consider, of course. will be considered in the gross estate calculation. Okay, so this is a small list, which is, no one might have thought like this should become in the gross estate. Gross estate means what? For a normal person, it's all assets which you own. Just take the fair market value of those assets and consider it in the in the calculation of your gross estate. Okay. Okay. So I think there's one question. Can you please walk through a real time scenario which covers all this three? Okay, that real time scenario, I'll take it in the later some other class. And apart from that, do you guys have any questions? Just post it in the group. I still have 7 more minutes to give the answers to your any of the queries. Okay, today we are going to keep it till here only. We are not going to take the final descendant return. Okay, I know this was today's topic, but it's just 2 pages. We'll start it in tomorrow's session first. Okay, today we just did a quick revision about the gift tax, estate tax, and yeah, only these 2 topics we have done it in detail, and this I will take it in the tomorrow's class. Regular class on gift and estate. Yes, now so the thing is, let me